You ready?
Ready or not? Here we go. Let's do it, Sasha.
All right. Another exciting edition of Accounting 101 for Founders. All right, we're going to talk about the principles of complete and accurate financials, or what we like to talk about as garbage in, garbage out. So let's start talking about solving for garbage in. What's up, Luke Fry, CPA?
Yeah, excited to get rid of that garbage. Nothing worse than having it pile up, and unless you've lived in New York and can tolerate it, it's nice to get rid of that smell.
I do love New York, but I don't love the garbage. All right, let's dive in.
Cool. Well, there's a handful of things we're going to talk about, try to keep it focused, and primarily going to be on categorization, which is a way to make sure that everything is accurate, bank recs, making sure that everything is complete, reviewing your financials, and then accrual adjustments.
Yippee.
So first, we'll start with categorization, making sure that things are accurate. On the simplest front, your financial statements. So bookkeeping is financial accounting. Your financials are your profit and loss, also called your income statement or your balance sheet. Typically, you get a transaction and you book it to one or both of these financial statements. But it's not that simple.
It never is.
No. And I'm sure that if you've ever had a bookkeeper before, or you've ever tried to do bookkeeping on your own, you encounter these situations where you're like, I don't know what the right answer is. And I often, as a CPA and prior bookkeeper, would get asked, what's the correct way to answer? And accountants love to, or the correct way to categorize. Accountants love to say it depends. And a part of the reason why is there are complexities here. So Sasha, we talked about some examples about like a marketing contractor and some prepaid revenue contracts. Maybe we should just dive into an example on the marketing contractor.
Yeah, totally. What are some examples where there is no right answer in accounting?
So say I paid somebody on Gusto for $1,000 retainer, and they are on for a marketing contract of some sort. And I have a rule set up in my accounting system to automatically categorize it to independent contractor. Great, right? But maybe, Sasha, you budgeted for that under the marketing budget. So you actually want to see it in marketing.
And so from an accounting perspective, something like that doesn't really matter. That's more like a business decision, right? You might want to say some contractors go into independent contractors, but some might fall under marketing budget because you're holding that and you want to see that broken out. For accounting, it doesn't really matter. It's kind of a choice of the business. So that's it. What's an example of like a cash versus accrual complexity?
Yeah, this is a good one. I highlighted this idea if you're prepaid for a year's worth of subscription, so you receive 12 months of payments today, you actually, on a cash basis, would recognize that all today. But on an accrual basis, you need to recognize 1/12 of that every month for 12 months. So,
meaning this month, like if you have a $100 a month subscription, somebody pays you $1,200 in advance, no discounts, just to keep it simple. This month on a cash basis, your revenue would say 1,200, and next month it would say 0. Where on accrual basis, you said you would divide that 1,200 by 12, 100 a month. This month my revenue would be 100. Next month my revenue would be 100. The year after my revenue, the month after my revenue would be at 100, and that would be different. And so accuracy in this case kind of depends on whether you're maintaining your books on a cash or accrual basis.
Exactly. And there's, also way more complex ways to think about this if you dive into tax or other things. But the most important thing is to be consistent. Be consistently wrong, and then it's easy to fix. And an example on what happens when your financials, your bookkeeping, go to your tax preparer, they might actually move something around. So your financial accounting that you did on your bookkeeping will not always and usually won't match your tax return because tax rules were made up and they're different than financial accounting rules. Great. So Did you always know what a chart of accounts were, Sasha?
I was something that we learned. I mean, of course, I always knew what a chart of accounts was.
Yeah. Yeah, so it's something that takes time to understand and kind of wrap your head around, but hopefully this is a good way to think through some examples. So travel and meals expense, contractor expense, you might identify there that a profit and loss shows your expenses, or your income statement shows your expenses. So those would be on that financial statement. Whereas computers and hardware, cash and equivalents are assets. So those show up on the balance sheet, what you owe and what you own.
And
So
so
those,
should we think of it simply as like a chart of accounts is like a list of categories that you can choose from when you're doing categorization?
exactly, like that contractor expense versus marketing expense.
Got it. And so categorization choices or charts of accounts, are these the same thing as sometimes they're called general ledger accounts, or is that something different?
Yes, exactly. Or ledgers in shorthand.
Got it. Sometimes these have numbers in front of them, depending upon whether you're
Exactly.
choosing to display numbers or not. So I might say travel meals expense with a series of numbers before or after.
Exactly.
Okay, cool.
So let's talk through an example. You might have had a bill, probably not from Figma. You probably just signed up and have a receipt for that on your Brex card or Ramp card. And you would just book that straight to software expense, which is on the P&L. That's the really simple way to think about it. But Sasha actually wants to explain a more complicated way to think about it.
But I should have done the other one. You're the CPA. You should have done this one. I wanted to include this because I think the simplicity way is like, oh, Figma is a software expense, and there's like this one-to-one relationship. But in accounting, it's actually a double entry account. And in this case, if you're paying for Figma, you're going to have a debit and a credit, which I always get wrong. But in this case, I'm looking at the screen, so I'm going to assume it's right because you reviewed it, and it's going to say debit, software expense. Great. So that's my category, but I'm also crediting cash, which makes sense because I'm paying for Figma, and that means my money is going down and my expenses are going up.
Exactly. Equal and opposite, just like Newton's third law. So another example, maybe you should take this one and I'll talk through the next part.
Paying a bill means, or receiving a bill, I guess, means something goes in accounts payable. And this makes sense. I haven't actually paid for it yet. So I'm not actually having any cash come out of my account. So it's going on a balance sheet. It's like a IOU, or we call that accounts payable. Just like if you're giving services to somebody and you send them an invoice, they haven't paid you yet, that would be an accounts receivable on the balance sheet, money that somebody owes you, but they have not paid it yet. So it has not been, cash has not changed hands.
Yeah, exactly. So if you
How'd I do?
You did okay. I would say that if you receive a bill, that's exactly right. But if you pay a bill, the cash is going out and we're reducing accounts payable, which is what this journal entry highlights here. So accounts payable is going down with that debit, and cash is also going down when you pay that bill.
You guys just make up these debits and credit confusing stuff just to keep your jobs, I think, but it's fine. It ends up working.
Yeah, somebody had a really good idea about 500 years ago, and it's keeping us in careers for sure. So that's pretty much categorization. Let's dive into bank reconciliations, the completeness part of accounting. I'm not sure if you have ever done a 500 or 1,000 piece puzzle, especially in the last few years or maybe 5 years, and got to the end and you had a missing piece. Nothing worse than spending hours and maybe bottles of wine putting together a puzzle and coming to the end and not having all the pieces. Well, that's what a bank rec does. And make sure you have all the pieces before you even start. But to go a little bit further, any of you as old as I am or older will probably remember a checkbook. So this is essentially what a general ledger like Puzzle or another accounting software does for you, is it tracks everything. And rather than handwriting it, we automate the transcribing of all these transactions for you with the dates and amounts for you. And then you compare it to the bank statement to make sure that your numbers are right. Another way to think about this, if you maybe are a bit more engineer minded, is a hash total. So there's a control total that we know the sum of those transactions equal the ending balance. If that's the case, I can assume that I'm right. I have complete information.
Got it. So in this case, it's money instead of puzzle pieces. You have a starting balance, you have an ending balance. There's a number of transactions in the middle that equate to a number that is a bunch of additions and subtractions, whether money's coming in out of your bank account. And you want to make sure that what is in your bank statement matches what is in your accounting software. That's a reconciliation. You're reconciling to make sure these things are exact, because if you're not, then it's like missing a puzzle piece. You're missing a transaction for whatever reason. You're obviously not going to have a complete set of financial statements if you are missing some money in or some money out. And so the reconciliation guarantees you kind of have all the pieces.
Yeah, it's a control, because we have these amazing bank feeds today. We have direct APIs that are even better, but sometimes the integrations with other platforms may not actually work, or they may miss something. And so some verification to make sure that they're correct is needed.
Cool.
Awesome. So you made it this far. Now it's actually time to do a first review on your financials. Do you do this, Sasha? Is that your actual face when you look at
this is actually, I was going to say, do I do these reviews? This is the part that I like doing. Actually, it's sort of like looking and catching for problems. I don't know if it works really well in the puzzle analogy, because you can't really put pieces in the wrong way. But the last one on the bottom is the one that I sort of like scan for first. Is something changing month over month, or is something the same? If it's changing like a lot, that's probably something to pay attention to. If it's not changing at all, that's almost certainly something you want to pay attention to. But I also like these, like, big numbers. You just want to review and make sure they're in the place that you want. Small numbers, similar thing. If you have a whole general ledger or chart of accounts or category that just has one little tiny small number, like, do you really need to throw off all your reporting for a $5 sort of entry? What's the negative one?
Yeah, negative might be some income or revenue got booked to an expense account, or maybe an expense item got booked to a revenue line. So it's a pretty easy thing to find. Not all negatives are wrong from the sense of an accounting point of view, but it's definitely something that should cause you to pique your interest, essentially.
Great. So we've done the review. We're all done, right?
Not quite. There is one more step, and that is, you have this beautiful piece of raw material that you're then going to do some accrual adjustments on. So we were talking earlier, Sasha, about some accruals. If you received some legal bills for, IP property or formation, or, changing stock options.
Closing a round of funding.
Absolutely. So you maybe don't, because you have a good working relationship with the lawyer, they know that how much money you have in the bank. They're not really that worried about collecting right away, but you are actually incurring an expense throughout the period. So if you're keeping like GAAP informed or GAAP based, accrual based financials, you should actually be entering an accrual for legal expense every month.
So, right. So if just to bring this together back to a founder, so you're closing a round of funding, you're going to expect, let's just call it $100,000 over the course of 2 to 3 months of work. You're going to get billed for that later. Usually, you should be creating an accrual entry, estimating how much that legal bill you're incurring in this part of the month and that part of the month, and the bill comes later, and then you adjust it or correct it because you're never going to probably get it right, but you should be doing that. I don't know how many people actually do it, but if you're going to be like a legit accounting, that's you want to do that, because it's going to be an accurate representation of your cash and your burn and your runway.
Absolutely. And to your point, this might be something a bookkeeper or a CPA does for you, but there is that final step, and then you should always review it again once you make these adjustments. But in a nutshell, that's really it. We went through basically everything you need to do to have complete and accurate financials.